Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
And that is me. Hello, cheaters. Yes, it's been a while since I've shaved. I'm Mike O'Connor, the architect of Cheat Sheets. Thanks so much if you subscribe to our free or premium version of Cheat Sheets. And if you don't, you can get entry signals and some relative strength reports free of charge sent to your inbox. And you can also subscribe for about $5 a month or $50 a year and get a more comprehensive data dump in every day with premium Cheat Sheets. So Cheat Sheets is basically a data service that models the market and provides buy-sell signals and allows you to form your market posture. We have two kinds of stacks, we call them. One is the relative strength rank and trend report. Shows you sort of what parts of the market using ETFs are rotating into favor and what parts might be getting dumped. And in addition to that, we have trading signals that come complete with a 10-factor checklist. And I think what I want to do before we even get going on this week's data is let the recording sort of walk you through the 10-factor checklist. If you're used to it, you can easily fast forward through this, but we'll be right back.
Well, hourly exponential moving averages is what you'd expect, and it will determine the bullish or bearish rating of the short-term trend in Factor 3.
I hate when a plan doesn't go to plan. Let's see if I can rewind that so that...
Factor 4 turns very bullish when stocks face serious institutional buying pressure.
Here we go.
Cheat sheet stacks with trading signals are where we grade and rank collections of stocks or ETFs that share a common investing theme. We help traders not only to identify the best trade candidate, but also best time to enter a position. This stack, for example, contains highly liquid exchange-traded funds, the kind perfectly suited for option traders. It's organized into three key sections. The ticker symbol, name, and description of the stock or ETF is here on the left. On the right are the actual trading signals. In this video, we're going to focus on the midsection, our proprietary 10-factor pre-trade checklist, and the resulting summary tailwind score. The first three factors assess the quality of the trend. The more time frames that are in agreement, the higher our conviction about future price direction should be. If a trade candidate's 10-week exponential moving average is above its 40-week EMA, then Factor 1's long-term trend is scored bullish. Otherwise, it's bearish. Similarly, when an asset's 10-day EMA is greater than its 40-day EMA, then its intermediate trend is scored bullish in Factor 2. Finally, the relationship between parallel hourly exponential moving averages is what you'd expect, and it will determine the bullish or bearish rating of the short-term trend in Factor 3. Factor 4 turns very bullish when stocks face serious institutional buying pressure. It's based on a technical indicator that measures the intensity of money flow into or out of the stock. In the most bullish scenario, persistent buying pressure builds until it finally explodes, sending prices much higher. Factors 5 and 6 are relative strength. When a stock or ETF price increases faster than the general market, it's said to be outperforming. Very bullish performance compared to the overall market, especially when it lasts over a 3 to 6 month period, is evidence of a very strong trend, one likely to deliver higher prices over a period of several months. The final four factors track the output of one very powerful indicator called the market forecast. Literally a predictive modeling tool, the market forecast indicator helps traders make probabilistic bets about price direction with wallet-fattening accuracy. It measures price oscillation across 4 distinct time frames, and it's the interrelationship between these 4 oscillators over the short, intermediate, and longer-term time horizons, which is key to anticipating price direction. We'll save a comprehensive overview of the market forecast indicator for another video. But in the meantime, because cheat sheets are designed as a bullish trend-following system, the more we see the word bullish, and the fewer times we see the word bearish across the final 4 trading checklist items, the more profitable we're likely to be. If your eyes just glazed over, don't worry, we've got you covered. We've combined and custom-weighted these 10 timeless pre-trade checklist items into a single proprietary and very powerful metric. We call it the Tailwind Score. It's based on the theory that everything is already collectively known about a single company's stock or collection of stocks that make up an ETF, and that knowledge is reflected tick by tick in the granular buying and selling behavior of market participants. So by rolling up relative strength, price trend, forecast momentum, and buying pressure, we give each security a grade and then stack rank them all, from first to worst. We eliminate 95% of the stack from consideration and stay focused on only the best of the best trading instruments. No need to overthink or overanalyze. Here's what to look for on the pre-trade checklist before acting on any entry signal.
Tailwind score above 50%. And that's at a minimum, I would say 60% in a lot of cases, especially in markets like this. And then as a general practice, we want one of the two trend moving average pairs, the 40 period weekly moving average versus the 10 moving average, or the daily moving average. We want the 10 greater than the 40 wherever we're trading. And then, of course, we want money flow to be, which is also called buying pressure. We want that to be bullish. Sometimes you get a numerical value of that. Buying pressure, money flow are the same. And basically a score of 0.1, that's pretty bullish. That means institutions are acquiring that particular underlying asset. And above 0.2, they are aggressively accumulating. Anytime we can get a consistent money flow score of above 0.2 in an uptrending market with relative strength better than the market for a period of 3 to 6 months, that is where we're optimal. Now, I noticed as I was looking at the relative strength and trading signal stacks that were showing in sort of that how-to video, that the market was a lot greener back then. I'm going to take you now to where we're at today. And for a frame of reference, I'm going to use Substack to kind of guide today's meeting. And you'll find all of the stacks that we're going to refer to here. And for those of you who may have gotten this in your inbox yesterday, I've updated this with some additional information. I think mostly in the premium or paywalled section. But we're going to cover it today. That's the nice thing is if you're all access or what we call a free subscriber, I promise that you're going to get to see everything today in this video, even though we make it accessible only to our premium tier of subscribers. So, the market is kind of in a weird spot right now. Shades of 2008 as a couple of banks blew up. I blogged about that a little bit on Friday. And I think that we're going to see potentially some fear ramp up based on the possibility of contagion. But my sense is, and that's all I've got as a sense, is that we're nothing like 2008 here. This was a pretty specific bank that held a lot of startup money. So I'm afraid there's going to be some people adversely affected. You never like to see that as the result of this bank over leveraging itself and trying to get out on the yield curve back when interest rates were sort of modest, looking for better return. And that kind of screwed them because then bond prices, of course, they move in opposite direction versus rates, and longer duration treasuries and other bonds, 10, 20, 30 years, they don't pay they don't pay well, period. But back in a screaming bull market with low interest rates, that was the only place to get anything approaching yield, maybe 1% or so. So for those who loaded up on 10, 20, 30-year treasuries before the Fed began its rate hiking cycle, that had a really deleterious effect on holdings because the net asset value of all that stuff plummeted. Meanwhile, the 6-month T-note, I know I've invested in a few of those at the beginning of the year. That's paying like 5% now. I think I heard 5.5% at one point. So what happened in the market last week is there were essentially two bearish forces. They were actually opposing bearish forces, but you can see the result here. And let me just absolutely confirm, since I am basically fat-fingered in my ability to execute one of these online webinars. I just want to make sure I'm actually showing you my screen, and I am. Okay. So what we're looking at is the global stock market condition stack. This is one where we take a representative sample of ETFs. So let me show you one other thing. By the way, cheat sheets is always best viewed on a computer or laptop. And you may not be aware of this because I know these are a little hard to read and there's some, graphic resolution loss. actually, if you enlarge these stacks, this is really how they're meant to be viewed. So the reason I chose Substack is that I was able to put these graphic files in a, mobile phone friendly format. But for those on a desktop laptop, you can just enlarge this and it becomes a really good resource. So this is what we're looking at is global stocks. These are all equities, and that's important. That way we're comparing apples to apples here. So there's representative sampling. The U.S. is about 40% of the total market cap of the world economy, global economy. And so the U.S. is heavily represented here with major indexes. We've got the Qs, which is the tech-heavy NASDAQ. We've got the SPY, which is the U.S. large caps, as SPDR, sometimes it's known, top 500 stocks. The Dow, which is the top 30 stocks, and IWM, which is small caps, very economically sensitive. And small caps is really where the story, I think, is best told about last week. So let me just go there real quick, and I'm going to dial up IWM. This is the Russell 2000. So you can see the Russell's basically gone nowhere for a year and a half, and actually went down last year. And the year prior, it went nowhere. So the Russell 2000 for the last 3 years, it stopped going up in October of 2021. It went sideways for most of 2021. The bull market ended, as far as the Russell goes, in February of 2021, and then sideways to down. However, you'll notice that the Russell has, and I'm looking at a weekly chart here, the Russell has begun to recover. And whenever we see Russell 2000 or the NASDAQ start to outperform stocks in general, there's an old adage that both of these indexes tend to lead the way up and the way down. They certainly led the way down while the large caps in 2021 were still screaming higher, especially tech. Russell went sideways, telegraphing eventually the big pull down in the market. Now, we have since broken through diagonal downward resistance. This was really our bear market. When I say was, from a technical standpoint, at least in the Russell, we broke out of the downtrend and we held this support level. And so we broke out, and the volume wasn't great, but this diagonal resistance, which was touched 4 times, we broke through it. And then there's always what we call a throwback retest back to a breakout point. And oftentimes when diagonal resistance gets punctured, there's a throwback retest all the way back down to the downsloping diagonal line. Now, there's a big ass candle right there because we had 2 opposing forces in terms of the cause for the downtrend. But at the end of the day, they really resulted in kind of a different style of trading, a different type of bearish trading, if you can imagine. So we got double whammied last week in this huge down candle. I'm not yet convinced that this trend certainly has not switched to bearish. All right. And let me show you kind of one of the really important moving average pair, not part of cheat sheets, but good for you to follow. We had what's called a golden cross here on the Russell a few weeks back, and price screamed much higher. We had the golden cross, and then we had what we thought was going to be a garden variety throwback retest and bounce, which all would have kind of confirmed basically a new bull market for the Russell 2000. Well, then last week happened. Basically, inflation numbers have started to get a little hot lately. Again, after spending 6 to 8 months after that peak in May of last year, the monthly inflation numbers, we were still experiencing increases in inflation, but the numbers were coming in gradually. Well, fast forward to the beginning part of this year, and that's not been the case. Wages have been persistently strong, and actually, perhaps they've softened a little bit here lately, but job openings have been incredibly robust. We had a 500,000 new jobs number. I don't know what it got adjusted to when the February jobs number came out last Friday, but I don't think it got adjusted down much. And then another 300,000 plus jobs on Friday. So let's tackle this first one, because that's one of the reasons that the market went down. The Fed chairman, Jerome Powell, gave testimony in front of Congress on Wednesday and Tuesday of last week. I think it was 2 days, and sent markets lower because he reinforced the fact that the inflation data was persistent and that the Fed would likely hike higher than the market had expected to that point and would keep those rates elevated for longer. So this was the second higher for longer warning. It was an upgraded version of an earlier higher for longer warning. And so that immediately caused the Fed or the market to sell off. Now, the second down leg occurred Thursday, Friday, and that's all the result of something completely different. It's nothing to do with inflation and the Fed. It has to do with the crypto contagion, where, it is related to the Fed in that interest rates are driving this kind of uncertainty, this, somebody, I think it was Kathy Wood last year, mentioned that the Fed, if they're not careful in their excessive pace of rate increases, could end up, quote unquote, breaking something. And so, this has been an unprecedented move higher in interest rates from a percentage standpoint. We're basically at zero. And let's call it 0.1. And we essentially raised a 450x over the last year with a series of 75 and 50 basis point moves. And so when you do that, weird things can happen, particularly with financial institutions that need to chase yields. That's the whole way that they make money. It's the difference between the interest that they have to pay their depositors and the interest they're able to make by investing the depositors' money. And of course, they only keep a small fraction of investors' money available to the pool of investors that entrust the bank with their money. Most of it is invested. And what happened last week is there was a run on the bank, one of the banks in Silicon Valley. And there was too many requests for cash withdrawal. And the bank had made some poor investment choices. As I mentioned at the beginning of today's chat, they were out in long-term bond land earning 1.5% when the market totally reversed during that time. And higher yield was found much shorter on the end of the yield curve. And so when bond prices, when interest rates go up, bond prices react by going in the opposite direction. And long-dated bonds in particular, while short-dated yield increased in price, longer bonds got crushed. And so that's what caused this sort of second down leg, because market participants are concerned now when you get bank failures, all of those investments and trading instruments that the bank was tied up with have counterparties. And now, of course, those counterparties are at risk of being defaulted against. The federal government is only good for the first, $250,000 per account. And so any firm with more money than that in any account is at risk of losing it. And apparently there's a lot of VC money tied up in the bank in Silicon Valley. And then there was a second bank problem. And now there is concern that we will see a spread of the contagion. So that's why you're seeing this waterfall collapse in stock prices. However, assuming the contagion doesn't happen and that inflation is the story that suppresses markets, assuming we get over this contagion, and we'll know in the next few days, it's good to keep in mind that the 50 is still above the 200, that we had this golden cross, we've had a brutal sell-off, and we should see the Russell recover very quickly after breaking this support level. You see there was huge volume on the move on Friday. There was decent volume the day before. So if the market is going to spring back, we should see a big boink, and we will retest the broken 200-day moving average. We'll either make that test and break through it, continue the trend, or we'll sell off for a while and make some lower lows and lower highs. So how can cheat sheets help us determine what's the likely direction? Well, whenever you see stock prices that deeply sold off, there's a limit to what cheat sheets is going to be able to tell you. The current data is, of course, going to say stay out of the market because we closed not only near our lows on Friday, but also our market forecast really got hammered. And so I'm just going to go over this once again. The intermediate trend, the green line, this is essentially the first derivative of price. It's an oscillator. It oscillates from 0 to 100. When markets are bullish, it's pointed up and going higher toward 100. when markets are bearish, this oscillator is pointed lower and heading towards zero. And one just basic rule of thumb is when we're heading down like this, markets are bearish. When we're heading up, or we're pinned at the very top in what's called the upper reversal zone, or pinned to the very bottom called the lower reversal zone, we are bullish. When we're pinned in the lower reversal zone, we're bearish. Pinned in the upper reversal zone, we're bullish. So sideways above 80, bullish. Rising above 20 and especially above 50 of this green line, bullish. And we've got various terms for the position of the green line and its magnitude, so you don't have to think about it. So for example, just reading this chart right now, this intermediate market forecast line is pointed lower below 20. That is very bearish. All right. And actually it could be going up and be below 20 and it would still be very bearish. Had the green line stayed above 20, we would have been, instead of very bearish, we would have had a just plain old bearish rating, and pointed lower above 50, but below 80, this green line would have been ranked neutral minus. Those are sort of the three stages of bearishness. Now, if we were to reverse direction tomorrow because of a big market move higher, it would take this line moving from below 20 to above 20. Right now it's 12. And although it's pointed lower, really, once we're below 20, the direction doesn't matter. We're very bearish. So it will take a move above 20. And you'll know that on cheat sheets. If it happens and we close above 20 and this line is pointed higher after breaking above 20, the market will get a ranking of neutral plus, meaning it's the most tepidly bullish rating we can get. So until we see that rating, we know that as far as the IWM goes, there's really not that much to do as far as any kind of trend following strategies in small cap stocks. I mean, that is the cheat to short circuiting your trading life. If you just want to look at the green line, if you have TD Ameritrade, and if you don't, you can look at my cheat sheets. And if you see very bearish, then you're done. That green line is below 20 and stuck in the lower reversal zone. And it's going to take some type of movement to make it higher. And that movement starts with these shorter time horizon market forecast lines. I'm not going to get into that today. We'll call that climbing a wall of worry when it happens. The only other thing I'd like to point out is that all three market forecast lines, with the exception of the market sentiment line, which is the longest term oscillator, think of it like, again, accelerator pedal for the market. That's actually still, it's pointed lower, but it's above 50. My guess is we're probably neutral minus on the long-term forecast. I have to look to make sure it is pointed lower. If it's going sideways or still up, then we're bullish. And the long-term investing climate is actually pretty good once we get through this noise. Now, whenever we have, this is something that's not programmed into cheat sheets. Whenever we have the market forecast green, blue, and red lines. Red is momentum, our shortest term time frame. That's factor 10 on cheat sheets. Blue is the near term line. That's factor 9 on cheat sheets. And the green one, of course, is the intermediate market forecast line, and that is that's a senior time frame, and it is factor 8 on cheat sheets. So we call the mustard colored line and the green line senior time frames because they're essentially accelerator pedals for the weeks to months and the months to years time frames. The shorter period time frames, the blue line, which is swing trading, a couple of weeks to maybe a month, and the red line momentum, that's your day trading time horizon. It's basically the 1 to 3 day health of the market. So right now we've got all three below 20. And whenever that happens, that's called a cluster. It's when all of these time frames are kind of pinned lower. Now that itself is not a trading signal, though some people like to take it that way. The signal actually confirms it's called a cluster reversal or a lower reversal zone bullish cluster. Those are kind of the terms for it. So it's when you get all three oscillator lines below 20, that's the cluster. The signal happens when the green line breaks from below 20 to above 20. That starts a potential new bullish intermediate cycle. Now, again, I'm talking about this green accelerator pedal line. I'm not talking about the actual trend line of the market. The market forecast tool is a leading indicator. It tells you what's likely to happen. It's basically first derivative of price. So what it's doing is it's extrapolating the speed in order to make an assumption about future market direction. So think of it this way. If you're barreling down the road at 50 miles an hour and you accelerate past a traffic stop at 60 miles an hour, we can make a reasonable assumption that, over the coming minutes, maybe even an hour, you are headed out of town on the road leading away from your house, right? Because you're accelerating away from point A to point B. And because you're accelerating in a bullish direction, we infer from that then that the forecast for price movement in the immediate future and to the near-term future is bullish. So that's a kind of a really facile way of explaining how these market forecast lines look. Okay. So that's the next thing we'll be looking for is green line moves from the lower reversal zone, very bearish, to just plain old neutral plus. The reason it's, neutral minus. The reason it's because it's pointed higher, which immediately gives it I do mean neutral plus. So it's weakly bullish. When we move from below 20 to above 20 and we're pointed higher, neutral plus. We point the other way, we're bearish. Okay. So that will be the signal we're going to look for to get our bullish posture back. So going back to cheat sheets, I know that was a little bit of a long-winded explanation, but the more times I can kind of walk you through the market forecast tool and this stack, I think the better. You'll become an expert on how to read this. Now, of course, the market went out on its close yesterday. Let me pull up the IWM. Way down here, you got a 14 tailwind score. So basically the sum of the evidence, the preponderance of the evidence in all 10 pre-trade checklist factors is astoundingly bearish. The IWM is very bearish. And I guess the one nice thing that happened is you'll notice that the cheat sheet, the red line actually bounced. I don't know if you can see this, but the reason we have a yellow instead of a red line is that we made it out of that danger zone, below 10. We actually bounced up, which means that we got a little bit of buying in the close. We did not go out on our lows. That's a tepidly, it's not what it is it's a non-bearish sign. Remember, I always say that when you see danger zone under 5, it's telling you something. It's telling you that right up until the last minute, institutions are dumping that particular instrument or stocks in that category. And so we didn't get that with the Russell. We got a last minute reprieve. Neutral doesn't mean we're not bearish. We are most certainly bearish, but it says that potentially the cascading downward spiral might be nearing its end. We still might open weak tonight or Monday or tomorrow morning, but I would interpret that opening weakness differently than if we had gone out on our close. It means that especially if we're down 8, 9, 10, 11 points tomorrow on the Russell, there's a good chance we'll reverse during the day. All right. Now the rest of the markets, danger under 5, EFA, which is the Europe, Far East, and Australia, which had been more bullish than most parts of the market. The Qs tech. Now you notice the Qs finished just above 5. So once again, while certainly in bearish territory, not in the worst territory. So there's a second index that is implying that maybe the carnage is closer to the end than the beginning. That's what we mean when we see these not going out in the danger zone under 5. Now, the Eurozone had a lot more to give back. It's been on a run, and you can see that even with all these red lights in the market forecast, trend, relative strength in multiple time frames, the long-term forecast still bullish, and the long-term moving average and daily moving average pairs, the 10, 40 exponential moving average pairs are all bullish. We're actually still above 50 here. However, we expect some follow through to the downside when Europe opens overnight. All right. And that's really the story here. Maybe the U.S. by just a fraction of a hair follicle is slightly less worse than rest of the world right now. But overall, our takeaway is we're bearish. Of 120 pre-trade checklists, there's 12 ETFs that are measuring here. 18 of the factors are bullish or very bullish. That's very low. When we're when we're rocking, we'd probably see something like 70 or 80 out of 120 bullish. Okay. All right. So what are the catalysts for this coming week? Well, there's some big ones here with the Federal Reserve meeting about a week and a half from now. I think it's a week from this Tuesday, Wednesday. Is that right? Yeah, St. Patty's Day next week. Yep. Fed the week after. This becomes a big one. You're familiar with the Consumer Price Index, right? The CPI. And there's two versions of the CPI, one that includes food and energy, one that doesn't. And it's the one that doesn't that tends to matter more from a Fed perspective. The market is anticipating that February's CPI number will flatline from January. So it's not expecting to increase. And of course, that's really important because if we beat to the upside on that one, that's not a good thing. It means prices are continuing to accelerate to the upside. That has all sorts of implications. So my guess is the market will reward a soft CPI, especially the core number. Now, of course, inflation is still pretty hot here. It was up 6.4% year over year in January. It's expected to still be above 6. And so imagine that. It's for every $10,000 you've got, you have $600 less buying power, assuming nothing else happened. You didn't get any interest or anything like that. That's not fun. And we need those numbers lower because I don't know about you, but I didn't get a 6% raise. If anything, my day job company's in big trouble. Okay, so that's a really important number. And then the rest of these are going to be what I like to call cosmetic window dressing around the CPI. Retail sales is going to be important. They're expecting it to contract bigly. That's typical after the holidays. But also, the Fed is trying to suppress the market. We're going to get auto sales numbers. Then we're going to get something else that's more of a forward-looking number. CPI, backward-looking number, core PPI, producer price index. That I think is a big deal. Now they're expecting it to go up less. So we had kind of a hot PPI number in January. Producer prices month over month went up 0.6%. They're expecting an increase, but a deceleration of 0.4. So look for a combination of softer numbers to be meaningful for the market. Market should reward slowdowns in inflation because it all ties to what will the Fed do. Okay. And then the Empire State Manufacturing number. This is one of those ones where the worse it is, I think the better the market's going to like it. This is kind of the opposite, right? So the market is hoping for some negative economic news so that the Fed will feel good about its rate hike policy. So it will hike less and get closer to reversing rates. Typically, markets don't reverse direction. We can go sideways forever, but we're unlikely to go on a bull run until the Fed is well into its easing, and we're not even done tightening yet. So we're still very much early innings in terms of the reset of the economic cycle. Be prepared. All right. So I'll leave the rest of it. There's housing starts, capacity utilization, industrial production, initial jobless claims. That's probably a big one too. They'll be looking for what they hope is a bigger number, meaning more people filing for unemployment. The market will reward that. I know it seems kind of it's so cynical, right? People's lives are getting upended, and it's good news for market participants. Layoffs at companies are always rewarded with, an update in the stock price. All right, let's take a look at our global assets. This is something I sent out. The first thing I want to look at is double shorts here. So let's assume that the market is going to continue to go down. The bank contagion is a problem. I'm just making this up. It is market down, or if inflation's really rear its ugly head, the market will start worrying about a 75 basis point Fed rate hike in a week and a half. So there's lots of overhang that could cause things to really break the markets down. But one of the things you can do is get an idea of what smart money's really up to. There's no better way to do it, in my opinion, than just basically to look at baseball standings. That's what we got. Imagine we have this, and of course, we can do this with any collection of securities. It just so happens the one we've chosen here are double short the market. I'm not going to get into the some of the risks around trading double leveraged instruments. I sent out an article in yesterday's blog that does it's a financial institution that does a fantastic job of covering that. I highly recommend reading it if you're not used to trading these. Okay. Proceed with caution. Now, if you are, what this will allow us to do is to kind of game the system about what's for real and what's just going along as bathwater. Okay. So we're interested in the babies, not the bathwater. We want the real stuff that market participants are lining up to short. And this will be some help. Now, one caveat, unlike every other type of stock that we make available on cheat sheets, the time horizons of 3 to 6 months is our sweet spot is, I think, extremely important. In other words, not to mistake short-term signals for wholesale changes in the market. If anything else, you can get upended by chasing the shorter, the front running the shorter time frame. A lot of traders can get whipsawed doing that. We do want that 3 to 6 months, sometimes longer perspective in order to feel really good about what's going on in the market. I would say these short instruments, especially when we've not been in a protracted downward trend. And although we're in a bear market, we have not been cascading downward lately. We've been kind of junking around sideways, going up, in fact, a little bit. You could argue that since last October, we've had a tepidly bullish run in the market. So keep in mind that with short, and especially leveraged instruments, the short term may matter more. Okay, but I can't give you specific guidance other than I cut my risk in half. I, instead of using like the 50-day or 40-day exponential moving average as my kind of line in the sand for placing my stop losses, I'm much more likely to use the 21-day. To me, the 21-day EMA is a really long term. I'll use the 10-day EMA. I'll use a 5/20 exponential moving average pair. So that's one thing I do is cut the risk in half, shorten up my time frames. But the other thing you got to do is, because these are going to be more volatile instruments, so you have to give them a wider berth if you trade them. So if, for example, you are used to setting a 1.5 ATR, average true range, trailing stop loss below the 21 period moving average, 21-day exponential moving average. These are designed to mimic twice the average daily return. They're rebalanced on a daily basis. They're set up to get tomorrow's return or decline, whatever it's going to be. And that's how these things work. So you got to give them 2x the wiggle room that you would give a normal everyday unleveraged stock. So if you're 1.1 ATR below the 21-day exponential moving average, for me personally, I double that and go to a 2.5 ATR, meaning I allow stocks to wiggle on average twice and a half their daily trading range as expressed as a moving average. So I basically take the moving average of the trading range for the same period of time that I take the moving average price. So how does that work? We set up what's called a Keltner channel. Keltner channel allows you to plug in a moving average. I plug in the 21-day exponential moving average, and then you're able to plug in I always choose the same moving average, a 21-day exponential moving average of 2.5 times ATR, average true range. There's a little setting in the Keltner channel. And then what you get on your charts, let me go show this to you. In fact, let me do that with SKF using the 21-day EMA. Okay. Let me go get a 21-day EMA here. Here we go. And you'll see I've got the 1.1 and the 2.1. That refers to average true range. Okay. So again, if you decide to chase the XKF, the double short financial, you're entering potentially up here. Here is your 1 times average true range below the 21-day moving average. Here is your 2x ATR below the 21-day moving average. By the way, if you'll notice that when volatility picks up, these don't increase proportionally, they get wider. That's why I choose this particular indicator, the Keltner channel. It's because the moving averages and the bands, the ATR bands that we're creating, are sensitive to volatility, so that you can have a move when the market is gyrating more that is proportionally wider than if the market is calmed down and not gyrating. So you can see how these lines sort of move in and out around that 21-day exponential moving average. What that means is that you're able to hold the stock for longer without getting, without having the stock just nick your stop and you get out of what would otherwise be a winning trade. This is managing stop losses is an art, but 2.1x ATR, the 21-day moving average, is normally my minimum way of managing short ETFs. Now you can see that's a hell of a distance between the exit and the entrance, but it's really only $3, right? So worst case scenario, let's suppose I do want to chase this, but I've decided that volume keeps price above this more recent intermediate high. And I don't feel like we're going to ever, but not in the near term, we're not going to trade below 20 again. I have no problem setting a stop loss that far down. Then I'll just position size for it if it happens. So that would be a big move lower, $3. So if I have $1,000 that I typically risk per trade, I would take $1,000 in risk, divide it by the $3 move that's potential if the worst case scenario happens. And that would limit me to holding 333 shares compared to if I were to, for example, I'm just picking something else. I don't think I have another good example here. Well, let's just pretend I got the 10-day moving average. Okay, so here's the 10-day exponential moving average. Let's suppose I decide to set my stop just below it at 18.29. Okay, so enter at 20.58. So slightly better than $2. So if I have $1,000 to lose, I'm going to be able to trade just shy of 500 shares instead of whatever I just said before, 300 shares. You see the difference in size? The wider the berth you give the stock, provided you stick to risk management, the fewer shares you're going to end up buying. So, you're looking for that happy medium between allowing the stock to wiggle and not being stupid about giving up too much progress in the trend. And that's why I think that for leveraged ETFs, for me, 2.1x ATR below a moving average that I'm comfortable with, and in normal trading that's not leveraged, 1.1 to 1.5x below a moving average. Okay. You'll notice again here in SKF, we had a golden cross of the 1040 moving average pair. So that signifies that we're in an intermediate uptrend. We also have money flow going higher. And of course, banks are melting down. And if they continue to melt down, this thing will explode higher. One of the strategies that one might use is if you don't want to enter this trade at an elevated level, you could, I don't know if it's optionable, but if it is, you could sell a put at around, my guess is probably $18, $19, $1 to $2 below your entry price. Will probably pay a decent credit, assuming this is an optionable instrument. And that's one way to deal with this. And that way you wait to get into the stock until your sold put gets exercised. All right. So just a review of how we're separating the grown-up women from the little girls here. You'll notice we have 3 tiers of watch list candidates. We have watch list candidate, which you're not seeing, bullish and very bullish. To get on the watch list, we simply require that the stock rank, whatever the length of the stack is, this is a relative rank, that it show up in the top 50% on average during the 3 to 6 calendar month sweet spot. That is the period of time for us trend traders where a transition from poor performance to strong relative performance, when you get it in this orange zone, like for SKF, there's a better chance that this has got some durability. The trend is going to last a little bit longer. And so we like to look for transitions within the sweet spot. And if you see this green light go on, it means that on average, during this orange period, the stock has on average ranked in the top 50%. So if you've got a 20 stock list, it's pulling in 10s and better. You can see we've had a big transition from high 20s way down here, lower rank, to single digits, higher rank. So this thing is in motion right now. The other thing is that to get on the watch list, we require at least a money flow score. Money flow and buying pressure, kind of interchangeable words, of 0.1 or better. So we absolutely got that. And so that's the minimum criteria for getting on the watch list. To become a bullish watch list candidate, you need the top 50%. You need money flow better than 0.1 and at least one of the 2 moving average pairs, not the short-term moving average pair. That's the 5 over the 20 EMA. I put that as a courtesy because some traders like to use that. For me, it's all about the 10 1040 daily moving average pair and the 1040 weekly moving average pair, one or the other needs to be bullish in order to get a bullish designation. And you can see that this 1040 moving average pair, the 10 is above the 40 EMA. And you can see that cross happened about 4 trading days ago. So in the intermediate term, we are bullish. And the Chaikin money flow is strong, and you know that because you've got money flow in your chart here. So these are good criteria. Now, to get to a very bullish watch list, there's 2 other big factors. First of all, to qualify for very bullish, and none of these do, you need to not only be in the top 50% rank on average during the sweet spot, but during this period where where the look back period is getting lower, more recent times, the performance needs to be in the top third in the stack. So increasing strength, top 50% on average. Again, it all has to do is average out top third. And you can see just eyeballing it, given the 30 plus stocks in the stack, when we're in the single digits most weeks, we're clearly in the top 33%. And then money flow needs to get above 0.2. Which it's doing. And then the final thing is both trends are bullish. So that's why this one's only got a bullish designation, not a very bullish. It's the lack of a long-term moving average trend, meaning the 10-week moving average is not yet above the 40-week moving average. Now, to be quite honest with you, in double leverage situations, I think it's very risky unless the market is going to go through a 3-year dot-com crash. Then trade your heart out in the weekly moving average pairs, but you can see what happens here. By the time the moving average pairs cross and you enter, it's over, right? So in a bull market, these things can go down for persistent periods of time, but leverage short, really even regular short ETF instruments, there's an old expression, markets crash down and they stair step up, right? So by the time you're trading a crash down, it's almost over. And that's why I think weekly moving averages are not a good idea. My own personal opinion, again, I don't have any back testing metrics to back this up, but I like more nimble metrics. So I favor shorter time frames than I would for any other type of trading vehicle using these stacks. Okay. So hopefully that helps you. Just eyeballing this. This is for real, for sure. SRS, interest rate sensitive. And you can see again the rotation from 20 to 3 from the 90-day look back period to the 1-day look back period with a 0.25, Chaikin money flow. And the only reason it doesn't have a very bullish is because we only have one of the two. None of these have long-term moving average crosses because the markets haven't been bearish, right? And I wouldn't require a 1040 bullish cross for reasons I've said. If anything, for the double shorts, the bullish here is really very bullish in my head. So let's see if we can find something that is too early yet. Here's one, the ultra short NASDAQ. Remember we were saying that the NASDAQ seemed to be hanging on a little bit better. It didn't go out on its momentum lows. Well, here's an example of late arriving NASDAQ. Now, the last 2 look back periods, the 20 and the 10, were clearly, when I say bullish, what I'm saying is bullish for a double short, meaning the NASDAQ was finally cratering, but it doesn't have that relative strength rank at all, either here or here. So again, something like the Qs, the short Qs, doesn't have the trend. The money flow is just meh, right? People aren't piling it into it. It looks like tech is going to survive. And that would be true for DGG. I guess there's a data feed error, whatever that is, just not enough bullish metrics here, despite the fact that just for this week during this crazy market pullback, it got a little relative strength bump, but no other metrics came along for the ride. Down here, on the other hand, you can see a persistently strong